Welcome back. I'm Pierre Daly, Managing Director at AdvisorAnalyst.com, and this is Insight is Capital. My very special guest today is John Goey, Senior Investment Advisor and Portfolio Manager at Designed Wealth Management. He is the author of a multitude of best-selling books on money, investing, and the industry we're in. And his latest book, released earlier this year, is Bullshift: How Optimism Bias Threatens Your Finances. John has over a quarter century of experience as an advisor to professional and wealthy retail clients.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
John, welcome. It's great to have you back.
Thank you, Pierre. It's a pleasure to be here.
So, John, we're at this place right now where short-term rates appear to have peaked. The yield curve has flattened, and investors have many choices they can make. For instance, when it comes to bonds, they can stay closer to the front end of the yield curve where, yields are around 5+%. Or they can even barbell ultra short-term bonds with that yield with something longer duration, for example, TLT, which has become quite popular. You have any thoughts on this?
I think both make sense. My bias is toward staying on the short end of the curve and managing risk in that respect. I think a lot of people can do well even in like money market type instruments. You're getting about 5%, and you're taking away any kind of risk in terms of short-term moves. Try not to be too cute. I think a lot of people tried to manage things, even staying on the short end of the curve a couple of years ago in 2022 and into the beginning of this year. And even those people on the short end of the curve, incurred some losses. So I'm not expecting any further rate hikes. So I don't want you to think that's the case. Yeah. But I don't think there's any harm in staying on the short end of the curve or staying in money market instruments in this market.
Yeah, well, that's just it, right? I mean, for the first time in a long time, investors have all the options. I mean, they can, you can calibrate your portfolio to whatever your risk tolerance is. If your risk tolerance is low, you can stay, at the front end of the yield curve. If you're willing to take some risk, you can lengthen your duration of your bond portfolio. You can even go right out to the TLT or to the long-term long duration bonds. If you think, at some point in the future, rates are, long-term rates are going to drop or long-term yields are going to drop, because then you're also getting the capital gain. It's one of those times where, there's a lot of uncertainty and mixed feelings about what's going on. There's, a few simple questions to begin. What are you optimistic about?
So I laugh because my concern in the book and in what I've been speaking about over the totality of 2023 is that I'm asking people to guard against being excessively optimistic. And as a result, my critics would say that I'm a pessimist. I don't think I'm a pessimist. I think I'm an optimist as well. But it is harder to be optimistic in a world where all of the tailwinds have been converted to headwinds, and I'm thinking notably with regard to rates having come down for 40 years from the early 80s until 21 months ago, and then they started going up in March of 2022. There's not a lot that I'm super optimistic about. I would say that it's important to look for products and strategies that offer steady, stable cash flows that are not as sensitive to where we are in the market cycle. So there are things like I'm relatively bullish on real estate investment trusts and multi-unit, multi-residential properties, because I think, and especially if you get out of the areas in the parts of the world where real estate markets are very frothy. So I'm thinking, perhaps say the U.S. Sun Belt. Everyone's moving there, and as a result, I think multi-residential, multi-unit residential properties are still fairly safe in this environment, and they tend to be good inflation hedges. I'm not so sure that inflation is going to move much in either direction for the next little while. And as a result, I expect it to hover somewhere in, let's say, the 3% range. And 3% is not awful. I mean, the governments around the Western world are aiming for 2 plus or minus 1. So 3 is right on the cusp of what the high end of the range is. And I suspect they will. The question is how vigorously they're going to try to move it even lower. But I would say things like multi-unit real estate, traditional inflation hedges like gold and metals and commodities, food, are the sorts of things that will probably be better off, better investments than other things over the next little while.
Interesting. You mentioned, that there's a lot of activity in the direction of the U.S. Sun Belt. There was a piece this week, I think it was in Bloomberg, about quoting Ken Griffin from Citadel, that Miami is will be the new financial center of America.
Yeah,
in the future.
Yeah, I saw that. I wonder if there's a certain amount of a Trump effect going on here since Trump moved from New York to West Palm Beach. I'm not going to hold my breath. I saw the comment. Yeah. I think New York is still pretty firmly entrenched as the global financial center and specifically as the American center. But we'll see.
For sure. It's just it supports your. I think. I just mentioned it because it's actually in support of your comment about the Sun Belt, but that people are moving farther south. I think COVID did that, had that effect on people, which is that if I'm going to be stuck indoors, I'd rather be somewhere warm where, I can go out if I want to. And,
there's no question that the Sun Belt is in the ascendancy, partially because of, I would say, pro-business state level governments, low taxes.
Sure, yeah, taxation obviously is a.
Yeah, so I think, and as a result, people are voting with their feet. They're going to places where if they can have better weather and lower taxes and whatever else, that's what they'll do. And so those states are growing like gangbusters, and it's the traditional states in the Northeast, as well, ironically, as California, that are actually losing citizens these days.
Yeah, I was just going to say that you have the Atlantic coast, the Northeast moving to southern climes, Florida, but then Californians are looking at at Texas, right?
Yeah, Texas and Arizona.
Yeah, exactly. And so, John, what are you pessimistic about?
This is my answer here, Pierre, is probably not going to be what you expect. My concern is not. It's a first derivative concern. I am concerned about capital markets because of a number of things, because of debt levels at the government level and at household levels, and the yield curve remaining inverted, and inflation remaining a problem, and climate change and globalization, and a whole number of things. If you're familiar with Nouriel Roubini's book, Mega Threats, he enunciates 10 different things that are sort of systemic, that are part of what's going on. So those things concern me as macro high level concerns. But my concern that I'm the most pessimistic about is the knockoff effects of how investors and the people who give investors advice will react if these bad news scenarios start to play out, which is to say, the industry says, don't worry, we'll get through it. But virtually everyone investing today has been investing in this 40-year environment of tailwinds rather than headwinds with regard to rates. And virtually everyone investing today has been investing in a time of peace up until Putin invaded Ukraine and now Hamas invaded Gaza. There are a lot of things that would cause people to suggest that the world changed somewhere around the beginning of 2022, and those changes seem to be systemic, and they're not going to be going away. And I'm pessimistic that the industry is jingoistic about, oh, don't worry, we're all going to be fine, instead of taking a steely-eyed look at what's going on and protecting themselves against the harm that may come. And I don't want to be Chicken Little. I'm not saying the sky is falling. I'm saying if the sky falls, you need to be ready. And I'm the most pessimistic about the state of readiness of investors today.
Yeah, I mean, there's so many things happening right now that leave a lot of room for thought. Like, for example, it's surprising that the Israel Hamas conflict hasn't had a more profound effect on oil, for example, on oil prices yet. That could come to pass if things widen. And that's obviously a lot of speculation, but it's just surprising. In the past, that would have triggered higher oil prices, but there seems to be a very because of the pessimism on the global economy. Eric Nuttall had an interesting comment just last week, and one of the things he highlighted was the fact that according to real-time data, China, which is supposedly in dire straits, coming out of their very long COVID lockdown, the banter is that their consumption of oil, gas was lower because things were slower there. But Eric Nuttall highlighted that from, I believe it was Rystad, which is a real-time reporter on consumption, and in particular in oil. Oil consumption is globally at the highest level it's ever been. Mm-hmm. But more interestingly, if you drill down into China's oil consumption is not low. They're running at a level state of consumption. It hasn't been disrupted. Their consumption of oil and gasoline and other fossil fuels has not been disrupted despite all the talk of economic slowdown there. So, it leaves you wondering, how much. I mean, obviously at the incremental level, OPEC has a real control over the incremental demand for crude oil, but it still leaves you guessing, like, are we in for a surprise? Is there a surprise coming in oil?
Well, so that's the thing about surprises is it's one of the illustrations I see is risk is defined as that thing that you didn't see coming, and which by definition is a surprise. It's I once read something about this.
I'm saying this in the context of your comment about Wall Street being very jingoistic about things and people being sort of complacent, saying, well, it doesn't seem to be having a problem. It doesn't seem to be causing a problem with oil shipments. So what? And
so I don't want to be. Yeah. You can't predict a surprise by definition. I'm not saying I'm predicting any one specific outcome is going to come to pass. What I am saying is that it seems to me that we're in an environment where there are a multiplicity of things that could come to pass, and I don't get the sense that any of those things are vexing people all that much. And that they seem to be almost whistling past the graveyard about, well, we've done fine in the past, except that the problems that we have right now are not the sorts of things that previous generations have had to deal with. I've got a simple illustration. I thought when you were talking, I thought of the story that I read a while ago when people were talking about risk in California, and people who are real estate investors were asking the real estate developers about the risk of earthquakes. And the real estate developers would say, there's that, but what no one asks about, and that's termites. And termites apparently do billions of dollars of damage to real estate in California, and yet no one thinks about it because everyone's looking about the top of the mine, in terms of what's available to them. And the availability bias of earthquakes being risky and being a consideration in California is the sort of thing that's top of mind. Meanwhile, termites, which are pretty much everywhere, are in many ways a bigger threat to property damage, but no one asks about it because no one thinks about it. And as a result, it goes unaddressed. And it's always the stuff that you don't expect that hits you. And that's what I'm trying to say is that by definition, I don't know what it is that people should be expecting, but I think they should be mindful of the fact that there are a lot of things that could happen, and they seem to be thinking that the definition of optimism bias is that bad things won't happen to me. Bad things happen, but people who have optimism bias think other people get divorced, not me. Other people get in car crashes, but not me. Well, statistically, the odds don't favor any one person over another. They're going to happen. But people seem to think that whenever these things happen, if they happen, they will somehow be impervious, that they're bulletproof. And that is the concern more than anything else that I have in late 2023.
Interesting. I don't know if you read Doomberg.
Yeah.
There was a really interesting comment in Doomberg, by Doomberg, this last week, which was about the connection between LNG exports from the U.S. and capital markets in terms of not capital markets, but bond markets, in particular U.S. Treasuries, and that because foreign buyers of U.S. natural gas or U.S. LNG, which, as you know, is an export that's on the rise, rapidly on the rise, partially due to the conflict in Europe. And what's missed in all that, which Doomberg points out, is that because oil is denominated in U.S. dollars, because fossil fuel products, natural gas, are all denominated in U.S. dollars, the Biden administration has to balance between, they're being lobbied right now to curtail LNG exports, and the Biden administration and the Treasury, behind the scenes, behind the curtain, they have to balance out these risks that if they cut LNG exports, that could have a dire impact on the bond market.
Right. And
it would cause the U.S. government to have to go and do much larger amounts of refunding on long-term treasuries. And
that would be an example of what I'm talking about. So there are a lot of these first derivative concerns, knockoff effects, things where systems theory doing X has an impact on Y, and people don't intuitively think of X and Y as being correlated in any kind of a meaningful way. And it's these things that people don't expect that can have an impact. And I'm not necessarily saying that there's anything wrong with the way the Biden administration is dealing with its LNG exports, but it's, as you quite properly point out, it's yet another consideration that needs to be balanced that most people never, ever give a moment's thought to.
Well, and it reminds me also, since it's related to fossil fuels, it reminds me of this ongoing debate, with ESG and, in particular, net zero 2050.
Yeah.
This, which is, gradually people are starting to realize it's a pipe dream.
Yeah.
And so when you look at again, knockoff or knock-on effects of ESG, for example, have been substantial for the last 10 years. And now that capital markets are, capital is a lot more expensive, 2 years hence, suddenly, there's less money for oil and gas exploration and development. These wind and solar power projects are, 2 or 3 times more expensive now to finance or to fund than they were, even 3 years ago. And
so
they are coming up for go ahead.
How that plays off there, Pierre. So we're now looking at a situation. You were talking about Eric Nuttall and oil consumption in China being higher than intuitively think. It's always something. So on the one hand, we have these net zero by 2050 obligations under the Paris Accord. On the other hand, we seem to be falling short. So it's sort of the worst of both worlds, where on the one hand, we need to break the addiction to oil. On the other hand, it's probably moving a little more slowly and less purposefully than we would like, and that has negative impacts for the planet based on climate change. But the other thing is that the more actively we try to pursue those goals through wind and solar and what have you, the more money is diverted from other aspects of the economy, which is to say, if other forms of energy generation are costing 2 and 3 times more than we expected, we can move aggressively to try to meet our obligations for Paris. But the money that we spend in order to meet those obligations is being diverted from money that would have otherwise gone toward business development and capex and what have you. And as a result, that too will have a knock-on effect in terms of economic growth and the prospects for the future. So pick your poison. Are we going to try to meet our climate obligation, or are we going to try to grow the economy? You can do either, but you cannot do both simultaneously. At least it doesn't seem that way to me.
Yeah, you can't have it both ways. Exactly.
Yeah,
you cannot have it both ways. I think the I like the ideologically or idealistically, I like the whole ESG thing. Does appeal to people's values, investors' values, and idealism is emotionalism as well, right? I mean, it appeals, it draws capital because people are passionate about one aspect of climate change or another, or inclusivity or governance. I mean, in the end, it's all risk management, and I think where the industry might have overplayed is on the idealism rather than the logic of ESG. And when you apply a logical lens to ESG, it does make sense from a logic standpoint to invest in companies that are responsible, and because they will also have, over the longer term, inherently less risk in their future that investors need to contend with. But I'm always befuddled by the battle that's going on between the idealists and the logicians about what the right moves are right now, and because idealism has more power than logic in terms of appeal, it's very it's causing a lot of ripples. It's causing a lot of problems down the road, where we're so focused on cutting emissions that we're also cutting ourselves out of energy down the road, where we're going to have to pay for it. I mean, we're going to have to pay dearly for it, and that's potentially long-term inflationary in a way that it rhymes. It's not the same as the 1970s, but it certainly rhymes with it in some ways, and it could be a lot longer lasting if we don't resolve global demand.
I don't think it's going to play out necessarily in terms of higher inflation, although that's certainly a possibility. That's not the scenario that I think is most likely. My most likely scenario is a reduction in lifestyle. That as we move toward meeting those targets, it means the money is being diverted toward clean energy and away from other things. And when you combine that with pre-existing demographic trends, birth rates below replacement, and an aging society, and fewer people working, and more people in retirement, and healthcare costs and other drags and that sort of thing, we're looking at we've spent. I've spent pretty much my entire adult life expecting GDP growth in the Western world at 3 or 4%. And now we're looking at GDP growth at once we normalize and come out of the post-COVID bounce boom, I would expect GDPs to grow at a much more modest, 1 or 1.5%. And when you look at inflation and interest rates being substantially higher than that, one of the metrics that various governments will use, they'll say, as long as we have the economy growing faster than current levels of interest rates and inflation rates, we're going to be fine. But I see interest rates and inflation rates at being well over 3 for as far as the eye can see, and I see
Right.
economic growth well under 2 for as far as the eye can see once things normalize, and that's not sustainable. And one of the things that we have to do to reconcile that, I believe, will be that we will all have to grow accustomed to a lower standard of living, and no one wants to talk about that. I mean, good luck being a politician telling people that, well, elect me and I'll help you manage the transition toward tightening your belt. Voters are just going to say, forget that, buddy. I want someone who's going to promise me, a car in every driveway and a chicken in every pot and nothing but good times and blue skies going forward. And that is the reality that we in the West we've grown coddled, we've grown complacent. We've had it too good for so long that we don't even want to contemplate making tough choices. And as a result, part of why we're in this mess with climate is that we've kicked the can down the road for a full generation already. And, one of the things that the research shows is the longer you wait, the more it costs. And now that people are starting to realize that it's a serious problem, who's going to pay that bill? Because the bill just got a lot higher.
Does it ever strike you as interesting that, like the cost of everything has been going up forever?
Yeah.
That has never subsided. We've never had like things that really matter. Like, for example, in the US, college education in the US has never gotten less expensive. It's never been deflationary. And the increases have been well above whatever the stated inflation rates are. Mm-hmm. But that goes for everything. Cars are dramatically more expensive. Like, you could buy a decent car. I mean, when I say decent, I mean, you could buy a luxury car for 50 or 60 grand, 10 years ago. Now they're all 100 plus, or more, like the cars that were once 100,000 are now 250,000. So is that really, are we really living in a low inflation environment? Even when there was supposedly no inflation, the prices of important things were rising, and the criteria for measuring inflation was always being adjusted, so that we would have this illusion that inflation wasn't a thing, and now it is all of a sudden. But now that it is a thing, suddenly we're realizing, the price of food has never gotten cheaper. The price of homes has never gotten cheaper.
It's the flip side of what I was saying a moment ago with regard to a 40-year-long bull market in bonds when rates go from in the high teens to effect zero by the end of 2021. Since the beginning of 2022, we're in a new world. Rates have raised and they're going to normalize at a higher level than people contemplated even when they started hiking them. I don't think 20 months ago anybody thought that we would be stabilizing at 5% or higher in Canada and the US.
For sure. No.
Remember, I was at a presentation that BlackRock gave about a year ago in late 2022, and they were saying that Kurt Riemann, who was their chief strategist, was saying that he thought the terminal rate for the U.S. was going to be around 5%, and everyone in the U.S. and everyone in the audience went, "Come on, it's not that high." And we're higher than that now. And that was just a year ago. And these are the top strategists from the largest asset manager on the planet. So things have changed, even in the fairly recent past. Even in a way that smart people that are supposed to know better have been surprised. And part of why inflation was not that bad, and part of why prices were not that bad, is because of that 40-year glide path downward in rates. It allowed people, it inflated asset prices for stocks, bonds, and real estate for that 40-year bull run. But it allowed governments through their central banks to keep inflation under control. It was a Goldilocks economy that, through globalization and importing cheaper goods because of cheaper costs of production from overseas, prices were in many ways either dropping or stable. And if they weren't dropping, we were getting much greater value. If the price of a car from 2001 to 2002 wasn't any higher, but we were adding driver side airbags and we were adding anti-lock brakes, more bells and whistles, because the last thing car manufacturers wanted to do was to lower the price of the new model relative to the previous model, so that the idea of a 2% inflation rate, which is stable and predictable and positive, that was more or less the world we lived in for 40 years. I would say 30 of those 40 years, inflation was between 1 and 3. And in the few years that it wasn't between 1 and 3, it was just barely below 1 and just barely over 3. So for 40 years, central bankers had an easy job. They could slowly let the air out of the balloon and not have to worry about it causing any kind of inflationary pressure, because of deglobalization and other things doing that work for them. And now for 2022 and 2023 and for the foreseeable future going forward, that's no longer the case. Now rates are higher for longer. Supply chains are threatened. There's now war. Climate change is the sort of thing that's going to be diverting money and costing money. And so that new reality is a challenge. I don't think investors have gotten their head around the glory days of investing being behind them. They still think the future will look like the recent past. And what's really recency bias is going to be very dangerous.
I can't help thinking, like our whole conversation, the subject, we're it's so circular, right? I mean, what we're talking about, but what's interesting is that this is the subject of your book, and this optimism bias, like we've been coddled, we have expectations that always have to be met, and we can't see how they won't be met. That's very interesting. I mean, I feel like we're just circling, we're circling the drain.
and believe me, and my challenge, Pierre, is that I'm trying to be a clear-eyed person who says, just look at the world realistically.
Yeah.
I'm not a negative person. I'm not a pessimist, but take off the rose-colored glasses, please. People they think that because we got through things in the past, that we will get through things in the future. But no one that's an investor today had to deal with a rising rate environment that's going to persist. We've had a 40-year-long bull market in bonds because rates have gone from ridiculous highs to basically zero. And so the world that we're in today is fundamentally changed from the world that any investor has known throughout their entire investing lives. Yeah. And they're not recognizing that. They seem to think that, oh, well, I've gotten through it before. Well, you got through it before because you never had to deal with it before. Like the world has changed. Do you recognize that? Yeah. And I don't think many people are prepared to really recognize that we're in a fundamentally new paradigm now, and that things are just not going to be as easy going forward. I don't want to say that you should you're not going to build bonds. John, you're not going to go around, having, no, not that, but whatever return expectations you have, they're almost certainly too high. And you should think about, your projections for what your future portfolio might look like, being 1 or 2 or even 3% lower than what they have been previously.
But I think to your point, you're not saying, you're not Chicken Little. You're not saying the world's coming to an end and all of that. What you're actually saying is, I think the point of what you're doing, the point of your work is to highlight the fact that we need to prepare for it.
Right.
We need to adjust our portfolios for it.
Yep.
We need to adjust our expectations, and therefore, if we adjust our expectations, then we can also act accordingly. We can also reconfigure or calibrate our portfolios to these new realities, as opposed to just having our head in the sand and saying, oh, stocks and bonds forever. There are a lot of interesting choices that investors can make, right, in the context of recognizing that as a society, we are too optimistic. As investors, we're generally too optimistic, or we've been led to be too up. We've been led down the path of optimism too much without the realities being pointed out, like, caveat emptor, right? I mean, like, you read a prospectus, for example, and there's all, every single warning is in the prospectus that the regulators require to be highlighted if in fact the issuers aren't self-policing. But I, as a former advisor, reading a prospectus was like, oh, this could go wrong. This could go wrong. The value of this could go down. The value at risk, all the different terms and conditions and things pointed out. But there have been many examples where those exact risks came to pass, and the investors in those vehicles, at the time that they invested, thought, oh, well, that could never happen. Oh, that's not likely, or the probability of that event is low. And then along there came, like 2008, the probability of AAA rated garbage, came to pass, right? So great points, John. I'm really.
I think the point that I'm getting at here is that people. They would say, well, those
adequately prepared
have always been in the prospectus, but they've never happened in my lifetime, and therefore they won't happen in my lifetime. And those caveats and those disclaimers are present in product documentation for a reason, because it's always been a possibility, but because people actually haven't seen it happen to them previously, they now think that it won't happen to them. And it's that false confidence that scares me.
I always, there's such a, it's a humiliating business. It's a humbling business, investing. And, I'm always reminded of one of my favorite, sort of centering exercises is, just sort of surrounding knowledge itself, right? Where, you think about what do I know? I know. Mm-hmm. And then, that's right. This very, that's the very, very thin wedge, what we actually know as individuals, each and every one of us, right? We all know different things that we know. We all know that we know different things. And then there's the wedge, there's the slightly bigger wedge, which is what we know we don't know, but we're aware of something, but we don't know much about it, like derivatives or what was one of the big surprises was term premium, which was a term discount for a very long time. And then all of a sudden, in the last couple of months, the term premium magically appeared, and investors expect to be rewarded for taking the risk on long-term bonds, and yields just suddenly skyrocketed. The 20 and 30-year yields went to 5%, right at the 5% mark, right? But no one expected long-term, TLT, for example, to take such a beating right up to a couple of weeks ago. Right. And then since the last Fed meeting, things have softened up a little bit, eased off on the yield pressure on the long-term bonds. But term premium was something. How many people know what that is?
Right.
I had it explained. I had it explained to me where I didn't know about it 2 years ago, when it was negative, and by a market economist that I know very well. And I didn't get it then. I didn't fully get it. And then, that's how you learn, right? You become aware of something, and then you realize it's there. What do I need to, what's going on with it? Why does that matter? And then all of a sudden, boom, it mattered again. And investors were taken to the cleaners by it.
I think Donald Rumsfeld, who was
what
talked about unknown unknowns, right? And
absolutely,
that's just another way of saying what I said earlier. It's the
and that's the gigantic part of the pie, which is what you don't know, and
by definition, you can't reliably prepare for it because you don't even know it exists.
Exactly.
And so what I'm worried about is the lack of preparedness, that there's not enough humility in the world, that people think they know more than they actually do, and that goes for me. I'm not suggesting that. I'm not trying to pontificate.
It goes for all of us. It goes for everyone.
Yeah, it goes for everyone. I don't want anyone alleging that I'm casting aspersions and not looking in the mirror. I recognize that I'm human and that I have these biases too. We all do. Daniel Kahneman, who won the Nobel Prize in 2002 for his work on behavioral biases, acknowledges he's biased. So we all have biases, and we all, no one really resists their own ideas. I think their own ideas are brilliant, and others are not so much. But if you have a paradigm of how you view the world and things make sense, and there are things that are part and parcel, such as these premiums that you're talking about that you're not even aware of, how can you properly prepare for that? How can your investment approach take these things into account if you're not even aware of the risks you're taking, and you're not even aware that these are things that you should be thinking about? By definition, you can't be prepared. And then,
I'm sure. I mean, if you look at and I don't mean to circle around TLT so much, but it's a big topic these days. But if you look at the flows into TLT this year, from the beginning of this year to a couple of weeks ago, I mean, investors were just investors of one stripe or another, because TLT has many different uses to many different kinds of investors and objectives. Whether you're a pension or an endowment, or whether you're an individual investor, everybody has a different use for this proxy. But for, this now famous ETF, and what blows my mind is that I'm sure that a month ago, when this term premium started to blow up, a lot of investors were saying, "What the hell is that?"
Yep.
Where did that come from? I didn't even know that such a thing even existed. And so let's not. I think the point is that there's far more we don't know as individuals, respectively. That goes to your point, which is that we're most atrociously not adequately prepared in our portfolios or in our lives for all these unforeseen events that can arise out of nowhere, seemingly.
Part of being human.
John, yeah, exactly. What is the smartest thing you've heard or come across lately?
Oh boy. You put me on the spot there, Pierre. I don't know. I can't think of anything that's particularly smart right now. Well, the one thing that I would say is
like a light bulb moment.
Yeah.
Something somebody said, or something that triggered you that was particularly smart.
Yeah. I'm trying to think of something specific, because I can think of two or three general things, but I think since you're asking for something specific, I'm struggling to find a specific things. Let me talk about a few general things, and if something specific comes to mind, I'll use it. So the first thing is, as always, don't be concentrated. Don't be too wedded to any one approach. So with your investing, maintain balance and be conservative in terms of this environment, because I'm still not entirely sure. And so for me, be conservative means stay on the short end of the curve, look at value stocks versus growth stocks, diversify internationally, and don't have all your money in any country or sector or anything like that. So those are basic truisms that have always been the case, and I don't think anybody would generally say much different at any time. But I think I like that. I think that's a classic. What's old is new again. And what I like about what you said is that it goes hand in hand with markets today. Like, we have access to everything now. We have, I'm quoting Brian Belsky, who we spoke to last week. His point was that, and he used a great example from a movie called Radio, where the character in the movie goes into the dining car of a train, and there, he wants to know what kind of pies they have, and the wait staff says, we've got apple and we've got cherry. Oh, I want both. Bring me both, right? And to Belsky's point was that it's possible to have a little bit of everything in your portfolio. Hence, to be adequately prepared for
what might come. And so, you can have two views on risk. You can have multiple views on risk, multiple views on, it's not just, things aren't binary, especially in the markets are never binary. We're not, it's not an on and off switch. It's not very effective if you're doing it or investing with an on and off switch, as implied by, years of talk of risk on and risk off. That was probably a byproduct of quantitative easing, which was that, either it's a good time to invest, it's a terrible time to invest, right? But now, it's neither of those extreme options. It's you really have to have exposure to a multitude of different risks, different ideas, different different trajectories and vectors and instruments. And with ETFs, it is possible. Even with mutual funds, it's possible. It's possible to have exposure to a multitude of things that you might never have, but that you probably wouldn't have even thought of fundamentally the last 10 or 12 years, because it didn't matter. But now it does matter again, because and it's because of rates that it matters again. It's because of the cost of capital that these things matter again. When rates didn't matter, everything, you could take, as we see, we had a period where we could take lots of risk and not be worried about the cost of capital hampering returns. But now the cost of capital is potentially hampering returns. It is causing dispersion again in the markets. It is giving rise to active management again. It is.
And it will, and it will do so, going forward, even if it stays where it is, because when it comes to things like mortgages and businesses having to renew their loans and what have you, there are a lot of people that have managed to, in the short term, lock into favorable terms and conditions, which will not be favorable when the time comes to renew. And so there's a lag effect. It's well known with regard to rate hikes, and that we had several bankers. Let me remind your listeners here, Pierre, that we had people like Tiff Macklem said it a little bit, but Jay Powell at Jackson Hole in August of last year, so we're talking 15 months ago, absolutely emphatically insisted that there was going to be pain, that he was going to do everything he needed to do to keep inflation under control. And inflation is down. It would be maybe a bit of a premature victory lap to suggest that it's under control, but it's not the worry that it was in August of 2022. But what has happened is that central bankers have not actually caused the economy to go into a tailspin. We still haven't got a recession. I still think a recession is likely because of the lag effects I mentioned a moment ago. I don't want it to happen. I just think it's likely to happen. And a lot of people, now they've got central bankers telling them there's going to be pain. And have they changed the way they've invested their portfolio? Have they changed? They haven't. And unfortunately, the narrative is such that, see, you lied to me again, central banker du jour, because you said there was going to be pain and there wasn't pain. And when we were supposed to have pain because of COVID, you had my back and you brought rates down to zero and you wouldn't let me experience pain. And investors and citizens are now thinking that, whatever they say, there's going to be pain. They've done, central bankers and governments collectively, because I think governments deserve some credit for not only averting what would have been a massive national health crisis in Canada, US, and elsewhere with COVID in 2020, but also a major economic crisis by backstopping people and giving them money. They feel that, we're going to be fine, and no one's going to do any harm to us. And as a result, they think they're bulletproof now. The worry that I have is that a lot of people think they're bulletproof. And I worry that people don't really worry. That's a first derivative knockoff. I worry that people aren't worried. That's one way of saying it.
All right. I mean, while you were talking, I was thinking of, the opiate crisis.
Yeah.
And, quantitative easing was an opiate for the masses. And now that it has been withdrawn, we're all sort of suffering from withdrawal symptoms, right? And cold turkey is hard. And
I think it's a very good metaphor. I think
Yeah.
it actually is a very good way of looking at it. I don't think I think it fits pretty well.
Now we have to deal with reality. Now we have to deal with, clear-headedness. We're not high anymore.
Yeah.
we're not wasted on oxy. We are, sober.
Yeah.
This is a very sobering situation in the market that we're facing.
Yeah.
So again, I mean, for that reason, I have to say I love the focus of your book. I think it's something that hasn't really been debated much as it needs to be. And,
well, it's the sort of the dirty secret of the industry. Optimism is good for business, and as a result, people in the financial services industry have a commercial imperative to be optimistic because it tends to gather assets and keep clients happy. And as long as that's the case, as long as there's optimism, the money is flowing, people are making money, and it becomes a bit of a game of it's game theory. So if you've heard of Greater Fool, where you don't mind buying high as long as you can find someone who can buy higher. There's no harm in speaking optimistically as long as you can get everyone else thinking optimistically and acting optimistically, then things will be fine. The problem is the same logic follows in reverse, that once pessimism steps gets on, it has a cascading effect downward. And we haven't really had that. We had a bit of a scare in 2020, and we had a 9-month drawdown in the first 9 months really of 2022, when the reality of the rate hikes, even before they started to set in, and people said, "Oh, this is coming," and we realized that, and markets being forward looking started to react even before the rate hikes started by 2 or 3 months. But now the reality of the lag effects kicking in, I don't really get the sense that people have fully grasped what they're in for, and so it's sort of like they've committed to getting off the opiate, but they're not off yet, and they can handle the end of it, but until you actually have to kick the habit, you don't know whether or not you'll be able to truly kick the habit. And that's where I think we are in late 2023.
Yeah, I think it's the idea that it's there in the medicine cabinet if I need it.
Yeah.
But then what happens when you go to the medicine cabinet and you find it empty?
Yeah.
Right. It reminds me, optimism is good for business.
Yep.
I like that. I think that'll be the title. I think that'll be the title of our conversation. But it made me think of something I've said to my kids, which is freedom isn't free.
Yeah.
Anyway, what's the dumbest thing you've heard? I mean, I think maybe we've implicitly or covered it in some of the things we've talked about right now today. But what is the dumbest thing you've heard lately?
Okay, I saw something on X yesterday, and it wasn't necessarily dumb, but it was an example of what I would call bullshit. And I think it's an example, it's an illustration of what I'm trying to show here. We had a massive up day on Tuesday, I believe. Markets had one of the best days of the decade, right. And it was a fantastic day. And the old chestnut that you frequently see from certain people in the industry was making the rounds on X, and that is, if you miss the top 5 days or the top 10 days, you're going to have a much lower return. Ergo, you should always stay invested. And the question that I ask, of course, is, okay, now do missing the top 5 or 10 down days. And of course, the industry doesn't do that. It's just a parallel. It's telling the same side, the same story, only with the opposite outcome. And of course, you would do substantially better. So does that then teach you to stay invested, or does that tell you to try to time the markets? To be clear, I am not suggesting timing markets. Nobody can do it reliably. What I'm saying is the industry will stupidly or naively or manipulatively tell one side of the story. You've got to stay invested because otherwise you might miss these massive updays like we had on Tuesday, the 14th or whatever it was of November. But the logic, if Tuesday the 14th was a 3% down day, you'd have missed that too. And so cherry picking the way you present the narrative, if the narrative is stay invested because you can't time markets, then tell that, say that. Don't just use this silly cherry pick story of, well, if you miss these up days, because a person who wants to be a troublemaker could just as easily say, well, if you miss the down days, and doesn't that then tell you should be timing markets? You can't time markets. Don't cherry pick data to try to support that narrative. Just leave it as it is. Be honest. You can't do it. Don't try to do it. But don't. It's just so cheeky to tell one side of the story. It's so salesy, and I just find it dirty when I read it. I feel like, oh, come on, we're better than this. As an industry, we should be telling the truth. Be honest, but be balanced. Don't just show one side of the story.
I like to have from time to time, depending on what's going on in the market, certain days, I'll have CNBC or Bloomberg running in the background, just to, just as an ambient noise. Mm-hmm. But every now and then, what I started paying attention to some time ago was just what things people say in passing. Because it's those moments in passing where people are just saying, off the cuff thoughts or what they really think, mm-hmm. not in the midst of answering a specific question, but as a parting thought at the end of what they've just explained. And last Tuesday, the 14th of November, to me, I recall the same day hearing from sort of general media that, the stock market was up and it was because of X, it was because of this, it was because of the reaction to, data.
Right.
But, regular investors were not pouring into the market that day.
Right.
Right. So to me, the misnomer of all, the mischaracterization of what that was is what always intrigues me and should intrigue people. I think on the mainstream or primetime news, they're just going to say, oh, there was a positive reaction to right. lower inflation data or lower employment, unemployment, the economy's slowing down, or signs that whatever the reason was that day and any given day. But the reality is that there is there's a whole cohort or cadre of short investors who are short. And when positive news comes along, it's bad news for them. So they cover. And they're the ones that are automatically pouring into the market. They're not pouring into the market. Oh, the market's a bargain. They're pouring into the market because they have to cover their positions. Otherwise,
counterintuitive, right? So markets are going up because short sellers are covering their shorts. Like that's
the
sort of thing that a man or woman on the street would even contemplate as being possible as a possible explanation.
That's the weird afterglow of reaction to bad economic news. So bad news is good news, but it's not, because you and I aren't jumping to get in there unless we know something, unless we sort of glommed onto something and decided, let's do it, let's get in there at this low. But the people who are coming in on those days and creating this afterglow reaction from bad news, from bad economic news, pointing to lower rates down the road, the possibility of a cut coming sooner than expected. Everything is expectations, right? But the only people who are coming into the market on those days are the people who have no choice but to come into the market on those days. And that's because they don't want to get a shit kicking. I've got this open short. I've got this open short and I have to cover it now, because if I don't, I'm going to be out, I'm going to be out $1 billion, or I'm going to be out hundreds of millions of dollars. I have to cover this position now. Right. And just, and that's where the screaming on the trading floors, used to happen. Now everything's done quietly through computers, but, that madness is not there anymore. But when mainstream media covers these stories, all they do is just provide a very general, very superficial explanation of what happened.
Yeah.
They're not saying who did it. But it's when you listen to the side chatter in the conversations that are taking place on financial media, the money managers, they know what's going on because they're the stakeholders. They're the ones who are in there, and they're not necessarily showing their cards because it's a very proprietary business for the most part.
Right.
But in passing, they might say things like, "Oh, it's a melt up. It's a short. There's some shorts coming into the market." That's what I listen for. I'm listening for those little quips and side comments or the sarcasm that happens in conversations. Sure it is. People say things. People who are more in the know than the rest of us, make these quips. And if you pay attention, you can catch those quips, and you can catch the one thing somebody said that was the most important thing they said in the whole 10 minutes they were talking.
Right. Yeah.
And
I agree. And a lot of the quips that I would say that I notice are things which they seem like throwaways, but they're designed to be to keep you optimistic. So don't worry, it'll all work out in the long run. And they'll just, there it is. It's reassuring, and I don't disagree, but things can be true and overly optimistic at the same time. But the industry always tells the positive side. The glass is always half full. And all I'm asking people to do is to consider that, when the glass is half full, it's also half empty. And just look at the half empty side, please. Just don't focus on it, don't obsess over it, but don't pretend it's not there, because it's there too.
Yeah. Don't just focus on what's going to go right. Focus on also what could go wrong.
Right. And there's actually a lot of research that when it comes to decision making, the people who imagine what could go wrong make better decisions in life. Is if you actively reflect upon what could possibly go wrong. So when we talked earlier 20 minutes ago about unknown unknowns, there might also be certain things that are known or can at least be reasonably quantified or expected to some degree. The extent to which you can focus on it before you make a decision will oftentimes lead you to a better decision, precisely because you've thought about, oh, was that a blind spot? Oh, did I guess I just thought of something that I wasn't thinking of before. Maybe I should, trim my position, or maybe I should buy X instead of Y, because although the upside for Y might be a little bit higher, the downside for X is a lot lower. And those sorts of things are things that people should think about.
Well, go forward with your optimism, but buy the insurance.
Yeah. And I'm not telling people not to be optimistic. By all means, be optimistic. Just, I guess I'm sort of like the financial services industry of Larry David. Curb your enthusiasm. That's what I'm saying.
When I go out of town and I rent a car, even though I have tons of personal insurance on my own, at home, I still buy.
Right.
I still buy the loss damage waiver. I still buy the additional insurance from the rental, even though it costs more, because then I can just walk away if I have to. I don't have to worry about it coming back and hurting me at home.
Right.
And it's this idea, like, we've had so many. You were on our other show, Raise Your Average, and we had last year. Earlier this year, we had a conversation about a lot of the same, many of the same things, not quite the same conversation, but we were talking about optimism bias. But, with my, partners on Raise Your Average, with the guys from Resolve Asset Management, like, one of the things we talk about portfolio construction all the time, but really what we're talking about is, put your portfolio together the way you like, but if you're wrong, make sure you have some kind of insurance. It doesn't mean buy insurance or buy options or, get into the futures market and hedge your portfolio. What it means is diversify.
Yeah.
And that's the hardest thing. And, the hardest thing for advisors to do with clients is properly diversify their portfolios, because there's this constant struggle of, getting the client, getting your client on board with why they should own something that is a diversifier, not a return enhancer.
Yeah.
not something that's going to go with what's winning in their portfolio right now, but something that's going to mitigate what happens if something goes wrong with the winning part of the portfolio. I want something else winning. If the part of my portfolio that got me this far, like investors have, they look at their portfolio and they say, why do we own, this energy fund, or why do we own these commodities, or why do we own these other, alternatives, whatever, you might have gotten them to, assume in their portfolio to express diversification in the portfolio. But whenever that review comes up for most advisors, it's an ongoing conversation, which is, my client came in and then, we were looking at the portfolio, and then you got the line item risk, right?
Yeah.
How do you first of all, what's happening in your conversations right now with clients? Like, when your clients are coming in or meeting with you, whether that's online or in person, what are the conversations like right now? What are clients expressing to you?
A lot of clients don't realize that they've actually done well in 2022 and 23. They're up. They're not up by a lot.
Yeah.
But they don't realize is that markets are actually down from January of 2022 to present. And so again, my job, the job of a good advisor is expectations management. And prospect theory, and specifically loss aversion, is the sort of thing that you were talking about a moment ago that I focus on. Is if you want to keep people focused on the long term, you try to minimize losses. And so, and the problem is clients, even though they've been clients for a long time, it's just natural. The media focuses on maximizing gains.
Right.
And when you focus on maximizing gains is great when markets are hitting all-time highs. But the all-time highs for the S&P 500 and NASDAQ and the TSX were all in January of 2022, 22 months ago. And we're still struggling to get back, and we may get back soon. And it may be another 8 years. Like, we may have a lost decade, and we may be almost 2 years into a lost decade. We won't know until 8 years from now whether or not that's the case. But people don't think of that. They think, oh, well, I'm assuming that my portfolio is going to have a 5.5% rate of return. And then if my return this past year was less than 5.5%, I'm going to hold my advisor accountable, and I'm going to ask him why we didn't get 5.5. And I'll say, well, we got 2.5 and the market was down 4. Like, why aren't you saying thank you for the 650 basis point enhancement relative to the benchmark? But that's not the way clients think. So the conversations that I have are one of expectations management, maintaining context, maintaining perspective. Returns haven't been great in the recent past, but they, certainly for my clients, they haven't been bad. And stay the course. We're protecting you in case there's more trouble down the road. The example that I would use, given what you were saying about drawdowns and being ready, think of, let's use the number 30%, because it works in both directions, up and down. If you start with a portfolio that's at 100, let's say it's $100,000, just to keep the math simple. It goes down by 30. Now we're at 70,000, and then it goes up again by 30. You're at 91. Okay, let's do it in reverse. You start at 100,000, you go up by 30. Now you're up 130. Now you're up to 130, but you go down by 30, which is 39,000, which is 91. So up by 30 and down by 30, you lose 9. Down by 30 and up by 30, you lose 9. The way you should think about apples to apples performance is to minimize those times when you're down by 30, because that's when it hurts you. It takes a lot more to get back up. So loss aversion and the asymmetry of the way people feel gains and losses is a very real consideration. It's called prospect theory. It's what one Kahneman and Tversky, Kahneman and Tversky did the research. Kahneman won the Nobel. Tversky had already passed away, and they don't give the Nobel away posthumously. But it is, in my opinion, one of the most fascinating and important insights to investor psychology, and it hasn't really been tested. I was listening to podcast in 2020 where a friend and acquaintance of mine were chatting, and it was a fascinating discussion. The acquaintance had only been a portfolio manager for 6 or 7 years, had not really experienced a downturn. And so because he got in after the global financial crisis, and he was talking about how gut-wrenching it was and how hard he had to work to get his clients to stay invested during the COVID drawdown. That
Right.
COVID drawdown lasted 5 weeks. It was a 33% drawdown, peak to trough, but it was over in 5 weeks. If we think we're heroes for keeping people invested for 5 weeks, what are we going to do when we actually have to keep people invested for 5 years or more? And I don't think people are really ready for it. And the people who give advice to retail clients are sort of throwing their backs off as they try to pat themselves on the back for the good work they do, and they do good work, but they're overstating their role and their impact if they think that they were heroes for keeping people invested for 5 weeks. It takes a lot more stick-to-itiveness than that.
Yeah, absolutely. It's interesting because in those 10 or 12 years after the financial crisis, I mean, we had quantitative easing, we had long and short-term rates that falling to zero over that time, and then equity markets obviously did what they did. They were incredible, and fundamentals didn't matter because the cost of capital was zero, or near zero.
Mm-hmm.
Credit was cheap.
Mm-hmm.
And again, if that's the recency, or the confirmation that investors have, and therefore also advisors possibly have, are prone to, having gone through, 10 or 12 great years in the market, getting the ship to turn has been really hard.
Yeah.
First of all, not just for investors, but for the advisors, even the advisors who are proactively trying to get their clients into diversifiers, into, first responders and second responders in their portfolio, are having a really hard time because as you said, there's so much focus on things like the Magnificent Seven.
Yeah.
Jeremy Schwartz did a great piece from Wisdom Tree, did a great piece on Cisco versus NVIDIA. And, he pointed out that, when the .com bubble burst, Cisco was really like top of the heap. It was, it's an incredible company. And now we have, and then what he points out is that, it's never recovered is the point. The point is that it has never resumed its previous highs. It has never, it's a great company, but it's been a terrible stock, right? So very often investors are getting the story that these Magnificent Seven or Enormous Eight companies that are ruling the S&P 500 these days are great companies, which they are, and they're all very big earners, very big revenue generators, like in a way that makes the .com era look like a Ponzi scheme, because these companies are making money hand over fist with their technology offerings, whether it's cloud or software. It's real, right? But the valuations are way, way beyond what's real, even no matter how much you love these companies. So something like NVIDIA is a very attractive company because it's been so great. It's such an incredible innovator. They're the beating heart of AI. You look at NVIDIA, but the problem with NVIDIA is the valuation. Not the fact that it's a great company. So again, investors have to delineate between what's a great company and what's a great stock. Yeah, I own shares in NVIDIA, whether it's de facto because, you have an index fund or you bought it individually. What are you going to do when the reality of the valuation being completely in the stratosphere becomes a concern, and investors start to look at NVIDIA increasingly as a stalwart, as opposed to a technology grower.
Let's look at that from the perspective of the entire market instead of just one company, because I think that's the
I'm
way
just highlighting NVIDIA because it's a darling.
Let's not beat up on NVIDIA.
It's like no. It's a great company, but it's a nifty 50. It's
right.
It's very akin to a nifty 50 type situation where it could have, as great as it is, it could have the return expectations because much of that has been achieved. It's not that NVIDIA can't become more valuable. For sure, it can. And I'm not slagging NVIDIA at all. I love the company. I think it's fantastic.
Priced to perfection. Yeah,
that's exactly the problem.
The illustration that I would use is a lot of your viewers and listeners probably know this, but the Nikkei 225 in Tokyo hit its all-time high on December 31st, 1989, and it was trading at a cyclically adjusted price-earnings ratio in the mid-60s, CAPE of about 65. And a historical CAPE for any given market is typically more like 16. So it was trading at about 4 times fair earnings. And guess what? Today, a third of a century later, the Nikkei 225 still has not regained the high that it hit on December 31st, 1989. It's been 33 years. So you can take a long-term view, but if prices writ large now, this is not one stock, this is now an entire benchmark index. At the time, the Nikkei was the second largest stock market in the world, benchmark index in the world. When it trades at ridiculous multiples that have no basis in reality, you could have a very long time in the wilderness as a result of buying good companies, but because they were trading at ridiculously stratospheric multiples and valuations, you're not going to make money. And Robert Shiller, who did the research behind the cyclically adjusted price-earnings ratio, who won the Nobel Prize in 2013, I believe, so it's now been 10 years since Shiller won, what he shows is that there's an inverse relationship between CAPE and returns for the market for the following decade. And when the CAPE gets into the 30s, oftentimes the return over that decade is around 0. And guess what? 2 years ago, the CAPE for the S&P 500 was in the 30s, which is why I postulated, why I said it would not surprise me if we were 2 years into a lost decade and that the next 8 years were also lost. That's not a forecast, but that is simply saying the fact is, historically, using Nobel Prize winning research, when the cyclically adjusted price earnings ratio for a benchmark gets to be that high, that's the average return for the ensuing decade.
For the entire market.
Market.
But what's interesting to point out is that during those periods of, energy field, there's I call it an energy field because it's a flat range bound market. Yeah. But there's also an intense redistribution of wealth taking place where assets are transitioning from high value, high PE stocks to the more attractive parts of the market.
Growth to
value. Whether it's,
typically
exactly.
Growth to value. Yeah.
Has the optimism bias that you wrote about in your book that we've talked about at length in our conversation today, has it flipped into a pessimism bias?
No, not at all. I would say that the problem is when you start talking about unknown unknowns, as we have on a number of occasions, the problem that I see is that people are optimistic and they don't even realize that the optimism is there in their DNA. It's the pre-installed factory default. People in the industry, if you're giving advice, if you're an investor, almost by definition, investing in the long term in the stock market and capital markets in general is an exercise in optimism. You do it because you believe in a better tomorrow. And I don't want to say anything that compromises that. I don't want people to think that I'm not optimistic. But the problem that I am seeing is that people continue to almost blindly forge ahead as if there's no risk without realizing that the world has changed going back to the beginning of 2022 and that the future will not likely replicate what the past was. That's not a forecast, but that's just talking about the things that we know for a fact have changed, and people have not changed their outlook and they haven't changed their portfolio. They continue to do things the way they always have because they think the future will replicate the recent past. And I'm concerned that it won't. And even if I'm wrong, I think people should start. What if I'm right? I'm not going to say I'm not going to say I'm right. I'm not going to say I'm wrong. But if I'm right, I'm trying to gently, respectfully ask people to reflect upon what could go wrong and then to make changes to their portfolio as a result. But that's a very difficult road to hoe because people don't want to contemplate things not going as well as they thought. And as a result, they put it off. And as a result of putting it off, if should it come to pass, I fear they won't be ready. And then they'll say, well, why didn't anyone tell me? And I'm going, I'm trying. I'm doing all I can to ask people as respectfully as I can to think about what they're doing and to take steps to mitigate the harm that could come should these things come to pass.
Yeah. So in a nutshell, stay optimistic.
Yeah.
But buy the insurance.
But be realistic. Yeah.
Be realistic.
People say that there's
diversify. I mean, by insurance, I mean diversify. I don't mean literally buying. You should have insurance all the same, but I mean, portfolio insurance in the form of diversification, proper diversification.
Yes.
Right. Really was a terrific conversation. I really enjoyed
I've really conversation
enjoyed it. Today. Please come back anytime. Love to have you on. You're a great guest because you have an out of market view, and I really appreciate it. Thank you so much. I think our audience will too.
Well, let's do this then, Pierre. If in fact if the things that I talk about don't happen, it'll be that was an interesting conversation that I had with Goey back in November of 2023, and that'll be that. But if in fact we have a major drawdown. And again, I hope we don't, but I fear that if we do, we won't be ready. If we do, let's have a conversation to talk about the way people are reacting and what you can do and whether or not people listening did in fact prepare themselves in anticipation of what could happen, accepting, of course, that no one knows what actually will happen.
Yeah. On that note, I would say, hope is not a strategy.
Right.
John, thank you so much for your incredibly valuable time and your insight. It's been terrific talking to you today.
Thank you, Pierre. It's my pleasure.